both of us.
Yeah, we'll both go.
Pig stuff.
Snort.
Okay, here. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm. Our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Their only request, a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme is Call Me Crazy.
Okay, you're crazy.
Yeah, that's it. That's all the trivia we have. So each commercial break we'll ask one of those questions. Our website is bestofinvesting.com. We're also on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. And by the way, if you have any questions, you can email Edward at bestofinvesting.com, and hopefully next week we'll air some of your questions.
That's right. Email questions are our favorite.
We love those. Okay. So, Mark, you got some good news for us here, or some interesting news.
Well, I wanted to talk a little bit about this issue of sales volume. So I found several different articles that talked about, the lack of inventory and the sales volume and why is sales volume so low. And this seems to be a recurring theme for the last couple of years. And so the first thing I did is I was curious as how the current California sales volume compares now as it did at the height of the market. So I found a graph. It wasn't hard to do. You just type in, California annual sales volume into Google, and that pops all these graphs. And because I saw in one of the articles a reference to sales volume last seen in 2005. And so I thought, what was the sales volume in California in 2005? Turns out it was approximately 750,000 homes were sold in 2005, and that was right before the real estate market crash. And in 2009, which is considered as the market was slowly beginning to hit its bottom, hit the bottom, because actually recovery didn't really start until 2011, 2012. But in 2009, those sales volume was about 475,000. And in fact, if you look at a graph of home sales have not gone above that 475 number in 2009 ever since. So in 10 it dropped down to the low 400s, same thing in 11 and 12 it ticked up a little bit, and 13. In fact, 12 and 13 were nearly identical at 450.
But the prices have gone up.
Right. That's well, the prices have gone up, but the volume has stayed level.
So what's going on?
Well, the prices have gone up because now we don't have the foreclosure activity going on.
Okay.
But really, let me just continue on for a point here. So in 2014, we actually had a dip again in sales volume. So you heard us talking maybe on prior shows that we had about 430,000 units sold in 2014. In fact, that was approximately a 7% dip from 2013. And 2015 is predicted to dip even further, probably right at around 400,000 units. So we've got this, this issue where a normal market is closer to 600,000 to 700,000 units on an annual basis. But when are we likely to see that? And if you believe some of the predictions that are on some of these real estate blog websites, we may not see that kind of level of activity until maybe 2020. Which, when I say that, sounds like, oh my God, that's so far in the future. But it's 2015, so it's really only 5 years in the future.
True.
But still, 5 years to maybe hit that next cycle where we might see sales volume. And of course, that assumes that we go on a building spree.
I was just going to say, what about construction?
Right. Well, so let's talk about some of the theories as to what's going on with low inventory. Well, anecdotally, we kind of know that home prices in most of California still have not reached the level of the last peak in 2006. And so because of that, because so many people bought homes in 2004, 2005, 2006, many of those people who still live in those same homes are underwater with their mortgage, or they don't have enough equity. Maybe they're not underwater, maybe they got 5 or 10 or 15% equity, but when you sell a home, and you pay the closing
Commissions
costs,
and all that.
commissions
Yeah,
and
sure.
stuff, which are not just the 6%.
Yeah.
They call, there's transfer taxes, all kinds of stuff. You got to figure about 8%
Sure.
to sell your home. If you only have 10 or 15% equity, what are you going to use for a down payment on the next house? So that's
Point.
so a lot of people are trapped in their homes right
And
now.
the interest rates are fairly low, and hopefully those people, the monthly payment is still low enough that they can at least stay in their house.
Right. So, so Kathleen Pender, who's a writer for the Chronicle, wrote an article just a week ago that said, "Why are so few homes for sale in the Bay Area?" And she listed a couple of things that I thought were pretty interesting. One of them is fear of buying. And so that's the old, if I sell my house, what am I going to buy?
Well, especially with not backup, but there's so many buyers coming in, and you get squeezed out, right?
Right.
The price is getting bid up. That people are unless they can afford to buy first and then sell.
So there's the fear of buying. The second one she pointed out was taxes. So if you're living in a home and your taxes are protected by Prop 13, you might have low taxes. So if you're looking to move up or even move down, you're staring at a situation where your property taxes could go from a couple thousand a year to 10, 15, 20,000 a year, depending on how large a home you're looking to buy. So taxes are another one. Another one is some people are moving out of the home they live in, buying a new home, and then not selling the former home because they're renting it out. Rents are so high right now in the Bay Area is that it makes sense from an investment point of view if they're able to qualify for a new home
house,
loan,
yeah.
then you go ahead and buy the new house, then rent out your other house, and especially those people who are renting it on Airbnb, you can make a killing.
Yeah.
I have clients who've come to me and are telling me, giving me the numbers of the income that they're earning from their rental properties, and they could rent it monthly for $5,000, but they're making $7,500 to $10,000 on Airbnb. So depending on where it is and how well you keep it up and what kind of service you provide, that's an option too. So so those were those were three things that we don't often think about: fear of buying, taxes, and the rental market. So that's pretty interesting. Then I found another article that said that according to a recent poll of the National Association of Home Builders, that home builders surveyed are saying what's keeping them from building more new homes is a lack of labor.
Really?
Huh. That surprised me.
That surprised me. You know what? The economy doing better, everyone theoretically is employed, and then they're having a hard time finding new people to hire. I got it. Yeah.
Yep. The uptick in overall employment has put additional pressure on finding qualified construction workers. Well, I know myself personally. I could have gotten started. I had several options for who to use to remodel a home that I'm working on a couple months back, but we decided to redesign the way we were going to remodel it. And now all of a sudden I'm calling people and they're going, well, I can't be out there until sometime in June. So it is there's a lack of labor there too.
Tell you what, we're going to cut to our first commercial break here. Now, last week, if you remember, we had a special trivia contest where the winner was going to get a 2-night stay at the Monarch Cove Inn. So looking for an idyllic weekend getaway or unforgettable spot to celebrate life's happiest occasions? The breathtaking Monarch Cove Inn stands on a 100-foot cliff overlooking Monterey Bay. Its 180-degree views span from New Brighton Beach to the southernmost point of the bay. Monarch Cove Inn has 9 rooms in an alluring Victorian house, as well as 2 cheerful standalone cottages. Each room has its own private amenities, including an outdoor entrance with breakfast brought to you in the room each morning. Secluded on a quiet road, the Monarch Cove Inn is a relaxing few minutes walk to charming Capitola Village. Check out www.monarchcoveinn.com. Now, our question was, over 15% of people on spring break will do this while on vacation this year.
Drink to blackout.
That's what I would have thought. But no, it's run out of money. Of course, it's probably from drinking to blackout.
Yeah, right.
So our winner was Ginny from San Jose. I wonder if maybe she ran out of money for that. Okay. All right, so now we're going to cut to our regular trivia contest, which is, was it Call Me Crazy? Is that the name of it? Yeah,
yep.
Call Me Crazy. Tiberius wasn't a very popular Roman emperor, but the Romans would probably have liked to have had him back after they got a taste of his successor. Who was his successor? The first three callers with the correct answer, it obviously must have been a little crazy or else the question would make sense.
Don't Google on your phone while you're driving.
Yeah, exactly. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. Tiberius wasn't a very popular Roman emperor, but the Romans would have probably liked to have had him back after they got a taste of his successor. So who was his successor? All right, stay with us. You're listening to The Best of Investing, and we will be right back.
So I'm going to continue on with a little bit of future predictions in an article. So I'll just kind of roll into that. I'll just recap quickly that we know that we have stubbornly low sales volume.
Yeah, so Rick's been emailing me.
Right, and I thought I might try to get here early, but then I got some calls and got hung up. But we can talk on the phone tomorrow if you have time about some of the deals that we got, because I all want to leave as soon as we wrap up, so I can get to the gym and stretch out and warm up before I
I had a good
get abused.
Good workout. Yeah.
Did you? Oh yeah, my workout on Tuesday was so gnarly. We did 3 sets of stuff that involved doing different exercises, some of which were cardio that got my heart rate way up, and I just
be careful.
I know.
Well,
he's our age, so he's trying to.
You doing twice a week?
Yeah.
All right. Away we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Baum, president of Pacific Private Money, one of the fastest growing mortgage investment firms in California. You got to check them out at www.pacificprivatemoney.com. All right, now we went to our first commercial break, and here was the question. The theme was "Call me crazy." Tiberius wasn't a very popular Roman emperor, but the Romans would probably have liked to have him back after they got a taste of his successor. Who was his successor?
I was never good in history, so I don't have a guess for that one. Unless it was Caesar. That's the only one I know.
Caligula. Caligula. He was a little crazy, that guy. Okay, Mark, continue. You got some good stuff for us.
Well, we were talking last segment about how California's annual sales volume has been hovering in the low 400,000 units on an annual basis since 2009, whereas in 2005, at the height of the market, we were selling 750,000 units on an annual basis. So based on what's projected to happen in 2015, which is less than 2014, which was less than 2013, that's 53% of the homes. So 400,000 versus 750,000, that's 53% of the home sales volume. And a lot of the reasons are, in my opinion, the reasons are a combination of lack of new building and lack of turnover of existing inventory because of a combination of people still not have enough equity, or they're underwater, so they're trapped in their home, or they don't want to sell and see their taxes go up.
Well, here's another part is they may not qualify for a new loan, whereas they're already in the house that's got one.
So where do we go from here? And I like predictions, especially the predictions from some of the blog sources that I read that I don't think are crazy. There's some crazy ones out there, but there's one in particular here that I like, and there's some information here. So the question is there any chance we might see a sales volume recovery in 2015? And of course, based on what we were talking about, the chances are slim. Now, in fact, there was one organization, First Tuesday, that is one of the places that I tend to go and read their articles. A year ago, they were calling for a price pullback in 2015. Now they're calling for that in 2016, and they're saying it's based on the fact that volume has been going down. They say that historically, every time sales volume goes down, usually within 9 to 12 months, it's followed by pricing going down. But they said that didn't happen in 2014 because at the same time, mortgage rates
They were
dipped
still
once
low.
again.
Yeah,
Right?
exactly.
We had that
Yeah.
dip again. We went from 4 at the beginning of the year to 3.5 at the end of the year. So they're saying that kind of canceled each other out. They're not predicting that to happen. I don't think anyone's predicting mortgage rates to go down from here. In fact, if anything, they're likely, based on general consensus, to be going up, ticking up towards the end of the year. So they're saying that by this time in 2016, spring, summer of 2016, we might see some pressure for downward pricing. So that'll be, so stay tuned for that. And again, as we talked about earlier, they don't forecast home sales volume returning to 2005 and 6 levels until 2020. So,
And what would even make it go up in 2020?
well, housing prices, we would have to have a cycle of appreciation where enough people now have equity in their homes so that they have the choice to be able to move.
Or they are paying down their mortgage enough if it's amortized.
Right. Now, of course, what happens as interest rates increase? We've been blessed with, 3.5% to 4% interest rates now for several years. It's interesting, though, talking about interest rates, I grabbed a graph of average 30-year fixed mortgage rate going back to 1991, so for 25 years. And it's an amazing graph when you look at it. Now, of course, the radio audience can't see it, but what I'm looking at is, it's hard to imagine when interest rates were 8%, but they were 8% in the year 2000. 99 and 2000 saw 30-year fixed rates right around 8%, and they started going down from there in 2002, 2003, 2004, 2005. They were going up and down around 6%. And again, I don't remember 6% interest rates because that seems so long ago. Now that we're 5, 6, 7 years into this recession, even in 2009, interest rates were averaging about 4.5%. So we've been really spoiled. We had the bottom of the market hit right at the end of 2012, and in 2013 we were at roughly 3 3/4 average interest rate. So what's going to happen? How is that going to impact housing prices and demand for housing as that interest rate goes from this what's been hovering around 4% back up to what's kind of a 20-year mean average of 5, 6, maybe
But
7 or 8%.
all kinds of things change, though. Unemployment, people's wages, people move into California, out of California.
Right, and inventory, right? If we see some increase in production, and that's really the big thing in the Bay Area, is that we have so many rules and regulations that really discourage new building. I remember all the building booms that were going on in 03, 04, 05, and it's you wonder, well, when is that going to start again? When are we going to see some of those vacant areas that were prepped for developments in the greater Bay Area and heading towards Sacramento and such? There's still plenty of places for them. I'm almost surprised that a lot of them aren't under construction.
Well, a lot of it has to do with environmental issues. A lot of people don't want NIMBYs, right? No, not my backyard.
Right, exactly.
A lot of that. Anyway, let's move on a little bit here.
Sure.
So, a lot of people who listen to the show, they know that you now have a fund. You've had it open since, was it July of 2013?
Right, May, June 2013.
2013.
Yeah, so
Okay.
almost 2 years.
Okay, so an email comes in that says, "Is your fund continually open, or will you close it at some point?" Because there's some people that have open-end funds, some have closed it.
So just a reminder for listeners, and if you just happen to tune in, my name is Mark Hoff, and I have a company called Pacific Private Money. We've been around since 2008 in the Bay Area. Pacific Private Money is a private money lender. We make mostly short-term loans to real estate investors and consumers. We're a non-bank resource for financing, and we generally have sprung up as a result of what happened when the financial markets crashed in 2008. The banks really just closed the spigots for new lending, or at least non-consumer home loan lending, and stopped making loans in a lot of areas where there's still strong demand, particularly the real estate investment community, people who are out there buying, fixing, flipping homes, contractors, etc. And including people who just have a short-term need for money. Now, all of a sudden, people weren't able to get easily home equity lines of credit on their real estate, and so the private sector stepped in, and companies like Pacific Private Money have been providing a lot of the capital to people who, for many reasons, don't qualify for bank financing. And since 2008, when we opened our doors, we've done nearly 1,000 loans in Northern California, mostly in Northern California, totaling over $200 million. And all of that $200 million is from private individuals, most of whom live right here in the Bay Area. In fact, we have approximately 250 private clients at Pacific Private Money who have invested in at least one of our loans, or they're a current investor in our mortgage pool fund. So when we first started out in 2008, we were really a matchmaker between people who were looking to borrow and people who had money that liked to invest in real estate secured notes. So we were just brokering between people who needed money and people who had money. In 2013, this was always on my goals list, to have a mortgage pool fund that many people in this business model would like to, if they have the ability to invest in the legal costs to form a mortgage pool fund. We in fact did that in 2013, and we have since raised about just under $8 million in that fund, and it's been paying out 8% to our investors pretty much since day one. In fact, we just had our first complete audit. They went all the way back to the very first investor we got back in, I think it was May of 2013, and reviewed all of the entries, the expenses, the income, and in fact, it was 100% clean audit. They had made no adjustments to our financials or our returns, so that was great. But the type of fund we created was what's called an evergreen fund, and that just means it doesn't have a specific closing date. So we opened up the fund. We designed it to be up to $50 million in size. We don't know that we'll ever actually reach that size. I know based on the volume of loans that we do at Pacific Private Money every month, which is on average about $5 million per month in fundings, roughly 20 transactions. Based on that volume, that would probably support a fund, of 30 to 40 million based on the short-term nature of it. But as we grow, our volume's also growing. So there's no plans to certainly to close the fund at this point. We've been open less than 2 years, and we see the business model for private loans to remain very strong going into the future. The reason I believe that is we just had Dodd-Frank go into effect, in fact, exactly a year ago in January. The most recent wave of Dodd-Frank regulations went into effect, and so now you have banks that are forced to follow certain regulations and restrictions when it comes to lending money to people. So a lot of people have fallen out of favor, so to speak, for many different reasons, either FICO scores, lack of income, they're self-employed, they can't prove their income, maybe it's a new job. There's all kinds of reasons why someone might not qualify for that 4% bank money, yet they make enough money to be able to own real estate, and they decide they want to borrow from it. So they come to companies like Pacific Private Money, and they borrow money anywhere from 9 to 10%. Hopefully, is short term. No one wants to pay that kind of rate for a long time, but we're there to fill the need, and we'll talk about some of the loans we've done in the next segment.
Yeah, that's right. We're going to do Deal of the Week.
Deal of the Week.
Deal of the Week.
Sure.
Okay. So here's our second trivia question. We're cutting to a break here. Again, the theme is Call Me Crazy. This First Lady was famously committed to an insane asylum by her son. Historians will debate whether she was really insane. Who was she? Okay. The first 3 callers with the correct answer won a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. This First Lady was famously committed to an insane asylum by her son. Historians will debate whether she was really insane. Who was she? All right, stay with us. You're listening to The Best of Investing with Edward Brown and Mark Hahn. Don't touch that dial. When we come back, Mark's got some very exciting loans to discuss with us. You're not going to want to miss it. Stay with us. Yeah, I'm excited to see what that Go Gross next.
Yeah, absolutely. I hope the 30-second spots are, have the intended result. I know it's certainly different than the 1 minute, but it's it's worth trying something different. So now we're getting tons and tons of spots.
Yeah.
30 seconds, and
If it
versus
doesn't,
a
we
1
can
minute.
always just go
Yeah.
back to a 1 minute one.
flop over.
See, the nice thing is that once you produce the results you're going to do,
Mm-hmm.
there's no reason why the 8 million of funding will go down. People are just going to want to add, tell their friends, stuff like that. So all
Right.
of those just grow. All right, here we go. Welcome back to the Best of Investing. Edward Brown and Mark Hunt are here. When we come to the second commercial break, we ask this trivia question. Call me crazy is the theme. This first lady was famously committed to an insane asylum by her son. Yeah, I said that without bumping my words. Historians will debate whether she was really insane. Who was she?
I have no idea, but I'm just going to throw out a wild guess. Marie Antoinette.
No, First Lady.
Oh, First Lady.
First Lady, yes.
Oh, okay.
Just First Lady. So she was one of the president's wives.
I should listen then.
That's okay. Mary Todd Lincoln. So Abraham Lincoln's wife, I guess after he died, she went a little crazy, according to her son, who seemed like such a nice guy in the movie. I'll tell you.
Spoiled brat.
Yeah, exactly. Okay. So Mark, when we cut to the break, actually, you know what? Before we do that, wanted to let people know. Guess what? Next week we are going to have another special trivia contest.
Love those special trivia
Oh yeah.
contests.
Now this one, get this. This place is in Temecula, which is down south, right? So if you're looking for an ultimate wine country escape, experience South Coast Winery Resort and Spa in the heart of Southern California, Temecula Valley Wine Country. It's a warm and friendly. They have a warm and friendly taste room, award-winning restaurant, decadent 3-story grape seed spa, retreat for the night in your very own oversized private villa or suite with a fireplace, private patio, and vineyard view. All of this and so much more awaits you at South Coast Winery Resort and Spa. Relax and enjoy. Call 800-730-5042 or visit wineresort.com. I don't know how they got such a good website. That's pretty good. Wineresort.com.
Awesome.
So check them out. That sounds pretty exciting. I'd like to check that out myself. Okay, so Mark, when we cut to the break, we were discussing, the loans that you do, but then we said we're going to get into deal of the week. Explain the loans you do.
So many of the loans we do are because we get a frantic call from someone who is in contract to buy a home, or maybe it's the mortgage broker who calls and says they have a client, and the deal's about to fall apart because the bank financing that they believed that they were qualified for all of a sudden is not going to come through. Either it's not going to come through in time and the contract's running out, the seller is not willing to grant an extension, and that happens in this market, especially if they get a higher offer right after they accept the existing offer. Yeah, that happens quite a bit. They're seeing dollar signs and they want to cancel that contract and sell it to somebody else, or maybe that it was an extended escrow to begin with, and oftentimes the banks will pull the credit report a second time, and sometimes things unexpectedly pop up. And again, when you're talking about the thousands and thousands of transactions throughout the Bay Area, the law of averages are that stuff happens, unexpected things come up, and now all of a sudden the bank's not going to close, and they call me up, and maybe they've got 3 days, 5 days, 7 days, who knows? But it's certainly too soon for another bank to do the loan, and so we're there for that reason, and we can act very quickly, and oftentimes those people will be able to refinance us out, take out our 10% loan, anywhere from within 30 days to sometimes it takes 6 to 8 months to clean up whatever the glitch was. Here's an example though of something that I feel good that that we have the capacity and the investors who have an appetite for a certain risk profile, but we're getting a lot of requests these days for seconds, and we're getting a lot of requests for seconds because banks just really aren't making them right now. I mean, they are if you don't need the money, right? I mean, that's
Yeah.
so bad. If you
Like-
don't need money, if you can prove
like a
you
home
don't
equity
need the
line.
money, you can get a home equity line. But if you need the money, it oftentimes doesn't matter how much equity you have in your home. You just don't fit the profile today, the very tight profile that banks want to see.
Well, when I hear a
Or
second, when I hear a second, immediately my antennas go up and go,
Well, of
"Ooh,
course.
a second, it's not as safe as a first."
So we've actually probably done maybe, I didn't count before we came in, but I would bet we've done 30 seconds just in the last probably 6 months.
Okay.
And one we did recently was, and this is fairly typical, guy calls us up, he lives in San Francisco, very strong market. He has a very, very low interest rate first. And in this case, the guy needed $175,000 to do some debt consolidation. And it was on his primary residence. Now you're talking a consumer loan. And quite frankly, actually a lot of hard money lenders out there won't even touch an owner-occupied loan, but at Pacific Private Money, we do. We do consumer loans. We make loans on owner-occupied property. We're not afraid because we've got a good team of underwriters, and we look at every single deal individually. We look at the story. We study what the facts are, and if we believe that everything makes sense and there's a viable exit strategy, meaning the borrower has the ability to pay us back, they're not going to get stuck in this loan, then we'll make it.
Before you get into the specifics on this loan, why are a lot of hard money lenders steer away from the consumer loans?
Well, quite frankly, they're afraid of the Dodd-Frank regulations that were put in place over the last several years, and more particularly in January. What has essentially happened now is there have been a lot of protections for the consumer against predatory lending, and so many hard money lenders have looked at these new consumer protection laws, which and have said, I'm not going to take the risk of making a loan to someone who can turn around and sue me later for making them a predatory loan. So attorneys who operate in the space of private lending have come up with, over the last couple of years, a set of guidelines for underwriting loans. Now, there's still the risk that we could make a loan to someone even after looking at all the facts, and they beg for the, they're begging us for the loan, or they have a real need, and everybody's happy when the deal goes through. But if something glitches and now all of a sudden they can't pay the loan back, there's the possibility that they could hire an attorney and say, you know what, we need you to look at this loan and see if you can get us out of it. And that's really what's the fear. And that hasn't started happening yet. This is the fear of what might happen in 2016, 17, 18 on consumer loans. Can they look at a loan and say, you know what, you knew I didn't have the ability to repay that loan. And so that's the risk we're taking. And so it's just a matter of, are you afraid of being sued? And for many people in the hard money space, they would just rather not take that chance. And so I grew up in the son of a real estate developer who took a lot of risk in his life. And he got sued. When you're in business, you get sued. Especially in real estate, there seems to be a lot of that going around. I can't be afraid. I feel like my personal experience is I can't be afraid of being sued for making a bad loan if you have a good file.
I was going to say that even if it wasn't a consumer loan, you can still get sued.
Well, yeah, anybody can sue anybody
for anything
in California. That's the reality.
Okay.
So for whatever reason, and of course, quite frankly, I'm thrilled that I don't have a lot of competition when it comes to consumer home loans. So we get a lot of really good calls.
Okay, so the San Francisco one, the guy needs $170,000 as a second.
Right. So his property is worth $1.5 million. It's a gorgeous property down in the Marina area. And
how big is the first?
You know what? I thought I had that information here, and I know you'd ask me because you're an accountant and you want to know all of the numbers.
That's it, baby.
What I do know is that with a $175,000 second, the combined loan to value of the first and the second was 60%.
Okay, so if they take $1.5 million, and then times 60%.
Yep.
Okay, that's 900,000. So subtract out 170, and you've got 730. So he's got a 730 first.
Yeah, it was actually 175. So it was a 725 first, 175 second. And the guy had good credit. His mid scores were just about 700. But the problem in this guy's case, when you Googled his name, up came a less than flattering legal issue. That was really very unfortunate, and they went to great lengths to explain to us and provide us evidence that what was showing on the internet really was a mischaracterization.
Are you telling me
of
that
truth.
the internet is not always 100% accurate?
Right, right.
So
But they said they couldn't get a bank loan because even though they believed they had the credit and the equity in their home and that they were bank financeable, every bank they went to did a Googled their name, came up with that and said, "I'm sorry, we're not gonna, we're gonna just no."
Oh, that's how I got actually one of my best loans years ago. Was this one guy, his front page on the paper,
Yeah.
because there was a theoretical situation that might have happened, and because it was on the front page of the paper, the bank actually called me up and said, "Edward, we can't make this loan. We need you to do it." And I said, "Absolutely, I'll do it." So, are you a little nervous about it being a small second behind a large first? But you said it was a very good interest rate.
It was a
first.
very, very low interest rate. If I recall, it was something like 2.5, 2 3/4. I mean, it was just such a great loan.
Yeah, you can't get the guy to take a whole brand new first at 9% or 10%. How much are you charging him on the second?
So that one was 11% note rate, and I think it was 3 points on that. We made a 5-year loan, even though he only wanted the money for about 12 months. He's in business, has his own business, and believes he'll pay the loan off in around a year. But due to the new regulations, we are not able to make short-term balloon loans less than 5 years on an owner-occupied property. So that's another reason why a lot of hard money lenders just say no if you call them for a loan and you tell them it's on your primary residence,
Yeah.
because many people aren't making these 5-year loans. So we made them a 5-year loan with payments amortized over 30 years. So they call it a 30 due in 5. And last but not least, the unit was a tenant in common. So it was 2 units
Banks
in
don't
the
like that.
marina that are they're called TICs, which stands for tenancy in common. So that's a certain legal type of unit that only a small number of banks will make loans on. So we actually do quite a few TIC loans in San Francisco, both first and second.
Do you have to worry about the person who is in bed with him, so to speak?
No, because the way the new TIC laws are, you can actually get a separate loan. You do not need to have the permission or the signature of the other unit owner. So
Because they are separate units.
they are
Totally.
separate units. They are like a condo, and it's not worth getting into the nitty-gritty legalese of it, but it's the next best thing to a condo, and there's just certain language you have to have in the note and deed of trust if it's a tenancy in common. So there is a little bit of risk there, but there's been so many loans made in San Francisco over the years on these tenancy in common. I think the case law is pretty strong that protects the lender.
Well, let me ask you, you said he needed the money for debt consolidation.
Which is a consumer purpose.
Okay, like credit card?
Credit card debt,
like
he had expensive credit card debts. This was going to save him considerable amount of money per month. He was already making good money, but with our 175 loan at 11%, he was going to be making his personal cash flow was going to improve greatly.
Yeah, because he's probably paying 18% or something.
Yeah, 18 to 24%.
How does he plan to pay off the 175?
He's a self-employed businessman. I don't want to get into too many details.
No.
I prefer not to.
Fair enough.
But he's got some sales that are happening, some very large sales that will allow him to pay it. He may not be all in one chunk. It might be in a couple of
That's fine. But anyway, it looks like he's got the ability.
He's got the income. He's got the ability. This was improving his bottom line family cash flow. Just there were just a lot of things. And it's in San Francisco. It's 60% combined loan to value. I don't see prices in San Francisco going down 40%. They didn't go down 40% in the last crash. They went down 40% in some real estate markets throughout California, but not in San Francisco.
It's in the marina.
Yeah,
That's pretty good. Okay, we're going to cut to our third and final commercial break. And here's the theme again. It's Call Me Crazy. She was believed to be the richest woman in America during her lifetime, but she lived as a pauper and was nicknamed the Witch of Wall Street. And I remember the story on this. Her son had his leg amputated because there was a delay on her part for trying to find a free clinic. So her son lost his leg, gangrene, something weird like that. So what was her name? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. She was believed to be the richest woman in America during her lifetime, but she lived as a pauper and was nicknamed the Witch of Wall Street. Who was she? Stay with us. You're listening to The Best of Investing with Mark Hahn and Edward Brown. Don't touch that dial. We'll be right back with some closing comments. Is that one available?
No, we
Ah.
funded that.
Oh, you
Kickstarter.
what? Oh, in the
Yeah.
fund?
Did we do that in the fund? I don't think we did. I didn't print out the second page, which has the lender on it. So I just have the
Okay.
loan summary sheet.
Don't forget to call me on these.
Yeah. No, I know. Everyone knows now. So,
Yeah.
so Rick understands. So you'll be hearing from him and Kevin.
Yeah, because I'm not afraid to do seconds. That one is a little odd because it's such a large first, but
Right. Yeah.
But it's-
175 behind 7. It's not quite. It's certainly not 10-1, but it's not 5-1.
no, but the interest rate is so low on the first, you can get them
Yeah.
to,
Actually, I didn't want to correct myself. It was actually we charged them 12% on the note rate.
that's
So, yeah. So that's.
yeah, I think I would like that one. Okay. We're not on the air. What's the name?
Jonathan Dickstein. So if you Google Jonathan Dickstein,
What pops up?
what pops up is that he was accused of misappropriating or doing something that had they have a special needs son who goes to a school, and he was accused of, what the heck was it now?
Like he's a trustee of the.
There was something about they accused him of submitting double submissions of his expenses to this organization that reimbursed partially the cost because of the special needs. And turns out that it was a misunderstanding and it wasn't really true. And anyway, it was.
Yeah, that's
it was
gnarly though. The guy gets nailed for that.
And he was an attorney, lost his license.
Oh my gosh.
Yeah, so, but he's just the nicest guy when you talk to him on the phone. So, of course, people who are, sometimes those people sound like the nicest guys, but
Like John.
yeah. Yeah. So, how many minutes do we have?
We have 8 minutes and 13 seconds.
Let's talk a little bit about the fund and
Okay.
how more people are getting into the lending side because they're having difficulty finding real estate investments.
Yes. Oh yeah. Good point. Okay. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, with Mark Hahn, president of Pacific Private Money. Third final trivia question. She was believed to be the richest woman in America during her lifetime, but she lived as a pauper and was nicknamed the Witch of Wall Street. What's that?
Tip of my tongue, I can't remember the name.
Hetty Green.
Oh, that's right.
Yeah, remember that name? Okay. So, Mark, off break, we were talking about how popular your fund is becoming. Well, why is it so popular?
Well, a lot of people who believe, like I do, that real estate is still the number one wealth building investment there is. And I do believe that. I've always believed it, and I still believe it today, that real estate is the best way to grow your wealth
Well,
and your
especially
savings over
since you
time.
can leverage it.
Absolutely.
Yeah.
So we have a lot of clients who are real estate investors, and right now we're in a market where we were talking early in the show. There's low inventory. Foreclosures are back now to normal rates. In other words, there was never a second or third wave of foreclosures. There's still people in foreclosure, but a lot of those, the banks are taking forever and allowing people more leniency, and they're doing workouts and they're doing loan mods and all that
and
stuff.
the cap rates are so low that it's just ridiculous trying to go out there and find real estate.
Right. So if you believe in real estate and you want to have a portion of your investment savings in real estate, a great way to invest in real estate without actually owning real estate is to lend to others who own real estate. And that's exactly what we do at Pacific Private Money. We work with people who both invest in individual notes, which we do, approximately 20 notes, 20 to 25 transactions per month. But we also have this growing fund for people who are not experienced in note buying or note investing. And if you're not experienced in note investing, in today's market, you're going to have a difficult time finding the quality notes because they're going to the guys who can make very, very fast, literally in 5 minutes, they can look at a deal memo and say, I want it.
Yeah.
Whereas someone who's not experienced, can you imagine being inexperienced about an investment opportunity and someone telling you, you got to let me know within an hour if you want to
Well,
invest?
I got to call
2
my
or 3 or
accountant, my
500,000.
attorney, and I got to call the box boy at Safeway.
Yeah, there's no way. I mean, there's that's just too stressful. So, one of the ways that you can take your time investigating an opportunity is in a mortgage pool fund. And a mortgage pool fund is it's a legal entity. They're usually set up as LLCs. The Pacific Private Money Fund is an LLC, and people invest money much like into a mutual fund. Now, it's not a mutual fund, but you can describe it like a mutual fund of real estate secured notes, because the only assets in the Pacific Private Money Fund, there's only two kinds of assets. There's cash, and then there's loans that the cash is funding. So there's loans secured by real estate, but the only two.
The one thing I want to make it really clear to people, because you had said, can you imagine people having to make a decision, in 5 minutes? I want to make sure that the audience understands it's not that you're taking 5 minutes to give up, like a borrower saying, Mark, you got 5 minutes to decide who you want to lend. It's more that you've got so many people who are clamoring for deals.
Yes.
It's the first person who basically says, yes, I'll take it.
Right. Investing in an individual note is usually first come, first served. Who's ever brokering the note, whether it's us or anybody else, they may be under a time crunch, but quite frankly, they can't proceed to the next step, which is drawing up the loan documents for the borrower until they know who the lender is going to be. Yeah. And so they put that out there, and the first person to come and say, hey, I want that, they get the deal. So it's a very fast-moving investment opportunity. Whereas investing in a mortgage pool fund, you can take your time, you can research you can take your time reading the private placement memorandum or offering circular, whatever document governs that particular fund, and then you could do your research on the fund manager, which in this case is our company, Pacific Private Money, or on me personally. You can check references, you can do all of that, and then once you decide you're ready, you can open up an account. And our fund has been paying consistently 8% since its inception, which is just slightly less than the average individual note pays. That usually pays around 9%. But the thing is that individual notes tend to get paid back really fast. So you go to the trouble of investing in an individual note, the guy maybe pays you back in 3, 4, 5, 6 months, and then you got to turn around and go find another investment again. Meanwhile, your money is sitting earning zero. So on an average annual basis, the difference between note investors at 9 or even 10%, and someone in a fund at 8%, it usually averages out to be about the same based on the amount of days that the average note investor has their money sitting idle. So anyway, it's I forgot what was the question.
I don't know. I just mentioned that the individual investor who wants an individual note, he might only have about 5 minutes to look it over, but you, with a borrower, might have 2 days, 5 days a week, 2 weeks.
Right, and I know the question. We started. I started getting off on a tangent there, and I forgot what the point was. Well, the point was is that a lot of people now who are and were real estate investors, and Edward, you have personal experience in this.
Yeah.
You have sold real estate, and rather than exchanging back into real estate, you've invested in notes. You've paid the taxes on the proceeds of the sale of the real estate instead of reinvesting in real estate. And by and large, I mean, isn't it true? You pretty much did that because you couldn't find anything that you thought was a good value because of real estate prices in many markets right now are just stupid.
Yeah, and also I didn't want to go through the brain damage of dealing with tenants and toilets and all that. And
you weren't in the mood to do a buy, fix, and flip because again, there's a lot of work that has to go into that. And hey, I'm happy to make loans to contractors and rehabbers who can find the property, and there are still great properties out there. I mean, I'm doing a lot of loans right now to people who are finding probate situations where beneficiaries are holding on to mom and dad's old property, but they don't know what to do with it, and they don't trust anybody, and they're afraid.
And they have to pay taxes, or they have some other expenses.
So how do you liquidate the property? And you don't want to sell it as is, because usually they're maybe haven't been remodeled in 20, 30, 40, maybe 50 years.
Yeah.
And here they're sitting on a potential gold mine, but they don't know what to do. So they buddy up with a rehabber, and we make them a loan, and they remodel the property.
Okay, so before we cut out here, how do people get a hold of you?
So for information about investing in notes, deeds of trust, or the Pacific Private Money Fund, we have a website for investors, which is pacificmoneyfund.com. Of course, all one word, pacificmoneyfund.com. If you're a borrower, we have a different website for rehabbers and real estate investors who want to borrow money. That's pacificprivatemoney.com. Or call us at 415-883-2150. That's 415-883-2150. 2150. Just leave a message on Saturday and we'll call you on next week.
That's it. All right. Here's our thoughts for the day. 2 quotes from the movie Fight Club. The things you own end up owning you. And it's only after you lose everything that you're free to do anything. Now, those are great quotes from someone who didn't even exist, if you remember the movie.
Mm-hmm.
Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.